Recession. The dirtiest word in the financial market. Despite central banks all around the world doing their best to stop a recession, recession still has a nasty habit of showing up every decade or so, screwing things so badly for us that moving back in with our moms seem like an attractive option. Now, if you are on the verge of moving back into your childhood bedroom, here are just 3 tips to help you survive a recession that you probably didn't think about. Now, of course, this is brought to you by Duedi, the Investor's Toolkit. Links to download the app are available in our description below, and while you're there, please do read the disclaimer.
Do you agree that losing your home could be one of the most painful and devastating things that anyone can go through? If you take a long, hard look at your expenses, you might see that the financing on your home takes up the biggest chunk of your income. During a recession, you could lose your job, get swamped with huge medical bills, and if you can't keep up with monthly payments or sell off your property, your home could be repossessed. Don't you think that by reducing that monthly payment, you could have more breathing room to sort out your finances and make your income and savings last longer? Your bank or lender could give you a hand by letting you refinance. Remember, they still own your property until you've paid off the loan in full. They would prefer that you keep paying on that loan instead of defaulting and forcing them to repossess and auction off the property. So what's refinancing? It's usually about stretching out the time period for the loan. For example, you could extend the term for the leftover balance on your loan, sometimes at a lower interest rate. You'll be paying less each month, sometimes a lot less. And that's a good thing because that'll leave more money in your pocket to get you through hard times. More money for things like food, daily necessities, and most importantly, Netflix. How do you refinance? Speak to your lender and find out the options for refinancing or restructuring your loans.
Insurance is probably the only thing that can make you feel good about yourself if everything you own is up in flames. Like that high maintenance partner that you've always wanted. If you never had to pay for it, you always want to have it. But insurance doesn't just take money away from you. If you are in an investment-linked policy, for example, if you dug deep enough, chances are there is some money that you can tap into. Because like its name suggests, investment-linked policies take a portion of your premium that puts into medical cover and the rest into an investment on your behalf. Now, if you've been paying your premiums for an extended period of time, chances are that investment has made some returns, which is deposited into your account, normally known as a cash value. Now, the cash value is used to pay for your insurance post-retirement usually, but if you really do need an injection of funds right now to stave off a very bad financial crisis, you could check with your insurance provider to see if you've got any cash value, but do check if you have to pay any early withdrawal penalties.
When times are good, it's easier to make money, so people tend to take more risk. But during a recession, when the market starts tanking, people keep taking those same risks, or sometimes even more risk. Logic dictates that when the market changes, people should change their game plan too. So maybe now is that time to take a long, hard look at your portfolio. You should ask yourself, do you have any duds? Are there any assets that could potentially turn around and make you some money, or are they all dead weight? It's hard knowing when to cut your losses and sell because it's easy to get emotionally attached to things like your fancy car, your nice watch, big house, your favorite tech stocks. Things which you might need to let go of. You're better off taking small losses quickly. You don't want to wait until the prices drop so much you feel like you really can't let it go. And you definitely don't want to wait until it crashes, which could happen. Because in a recession, it could take years for prices to go back to their previous level, let alone climb to make you some profit. For example, a stock that drops 50% has to climb back up 100% just to get back to where it was before. How likely is that to happen? How long would it take? Are you willing to have your hard-earned money stuck in that asset? Because in a recession, cash is king. It doesn't matter how much Apple stock you hold if you can't put food on the table. Cash also gives you options. When opportunity comes knocking, you could take advantage of it, compared to somebody else who doesn't have the cash to invest. So sit down, take a long, hard look at what you have, and start making the hard choices now about what to keep and what to let go, so you don't have to make even more difficult choices later on.
Well, they say necessity is the mother of all invention. If you are trying to find a way to invent yourself out of a financial hole, those were just 3 tips to help you survive a recession that you probably didn't think about. So if you got any good ideas to share, do leave your suggestions in the comments below. And while you're there, give us a like and subscribe. We really do appreciate it. Now, of course, if you're wondering if you're going to have any issues handling or paying off your loans based on your current financial situation, the Duedi app has a brand new loan default risk calculator, which allows you to do a quick self-assessment so you know if you really need to speak to that loan manager of yours. Till next time, this is Reactive Labs signing off.